Welcome, everyone. We're going to get this kicked off since it's the middle of everybody's workday, and we'll have folks join in as they can. So first of all, my name is Charlie O'Donnell. I am the sole general partner at Brooklyn Bridge Ventures, a pre-seed and seed stage firm that leads, co-leads, or just participates in very early rounds in New York City area companies. Generally non-specific to any particular industry, and usually pretty active, which is sort of how I came at this meeting. And one of the questions I get a lot from some of my co-investors, especially from angels who might not be board members, and people who are starting to do this first time, is thinking about their responsibility, right? Like, yes, they'd like to maybe become investors, maybe they've done some deals. Sometimes it's when, something goes wrong and they want to know what they're actually responsible for. But even, well before that, they say, hey, if I'm going to be doing this, if I'm going to start writing checks, I want to make sure that I'm doing the responsible thing. I want to make sure that I've got all my legal responsibilities covered, and the company is doing the same thing, right? And so, across all of the deals that I've done, some of the best experiences that I've had in terms of dealing with counsel have been with Alex. And so, I thought I would invite him in to come and chat a little bit about some of the stuff that he sees, and just help clarify, what some of the responsibilities of, investors are in different situations. So do you want to just introduce yourself and give us a little bit about your working history?
Sure, absolutely. So first of all, thanks for having me here. Very glad to have the opportunity to chat with folks. My name is Alex Ray. I'm a partner at a law firm called Goodwin Procter, and I've spent pretty much my entire legal career sort of working with startups. I spend about half of my time on the company side, working with sort of pre-incorporation, couple of founders trying to put a company together, all the way up to pre-IPO private companies, and spend about half of my time on the investor side, either helping investors invest in new companies or manage issues with their portfolio companies, and have spent a lot of time over the years talking with founders or talking with investors about how to sort of navigate tricky situations where there's not one sort of clear right answer. So happy to have the opportunity to chat with you guys today, and hopefully we'll give you some sort of practical advice on how to navigate situations that come up with your portfolio companies.
So let's run through this a little bit in maybe chronological order is the way that I'll think about this. And so I am a startup founder, and I haven't even gotten investment yet. And what are some of the kind of checklist things from a legal and governance standpoint? I haven't taken on investor capital, so obviously I don't want to spend a ton of money, and but I don't want things to come and bite me later. But what are some of the basics that you counsel? And in particular, let's assume I have a co-founder who I'm working with as well. What are some of the basics on that checklist that you counsel founders for, even before they go into any kind of an investment period?
Yeah, so some of the trickier issues that come up early on, they tend to relate to two things. One is capitalization, right? So how much of the company do the various stakeholders own, right? Who owns what percent of the cap table? And then the second issue that comes up a lot more than I'd like has to do with intellectual property ownership. So those are the two sort of potential company or deal killing mistakes that I see people make early on. And then the third thing, which is more of an inter-founder issue, is sometimes people are hesitant to have just an upfront conversation about how the entities can be managed or who's going to call the shots on an ongoing basis, right? So basically, who's going to be on the board, who's going to act as CEO, and who's charged with making the sort of day-to-day key decisions, and then who essentially is the board that's managing the CEO. And the good news is that the sort of the capitalization and IP related conversations can be relatively easy. You got to figure out what the equity split's going to be between you and your co-founder, and sometimes that's a difficult conversation, but you have it up front, and then you just need to make sure that you've properly papered who owns what percentage of the company, and you're super diligent about making sure that your co-founder, anybody who's an advisor, a consultant, an employee that you're hiring on a trial basis signs a piece of paper that says the company owns any IP they create, and you've probably dealt with like 95% of the problems on those two fronts. And then the other thing that I always counsel founders to have just sort of an upfront conversation about is again, who's going to be on the board, who is ultimately responsible for making the big ticket decisions for the company, whether it's the decision to sell or not, the decision to raise capital or not, because you'd be surprised sometimes people sort of avoid uncomfortable conversations up front, and it becomes a sticking point, when they're raising capital or have to make some other sort of key early decision.
So let me ask you a couple questions about some of the stuff I've seen become issues at this early period of time. So, we said the term co-founder, and actually I got an email the other day that says, hey, I have an idea, I need a technical co-founder. And one of the things I counsel people is that you may need somebody whose skill set complements yours, right? If you are building a technical product and you don't know how to build a technical product, you need somebody to do that. You may not have a lot of money in cash to pay this person, so you may have to give them equity. But then calling them a co-founder is an entirely different thing, which not a lot of people realize. And so I know there's no, or you can tell me if there is, I don't think there is, like, legal definition of what a co-founder is. But what are some of the things that elevates a co-founder above any other employee? And what are some of the considerations? And can I give people, or what are the considerations when giving people some of these things when I'm not totally clear if they're my like true partner forever?
Yeah, so it's funny, this issue comes up a lot, in particular in the situation where it's like you need a technical co-founder or a CTO, you have no cash. There's often a pretty big gap to bridge in terms of the amount of equity you want to give and the amount of equity the person can command in the market. You're right that it isn't really a legal distinction, it's more sort of a psychological or emotional one. And the mistake that I see people make a lot is sort of essentially title inflation, right? Calling somebody who is not 100% committed, not going to be working 24 hours a day, foregoing salary, in the same way that a lot of early stage startup founders are, who gets a founder title and assumes that with that comes sort of, even if the equity split isn't 50-50, assumes that all the sort of major strategic decisions are going to be made as equal partners. And so again, it just goes back to trying to have sort of, even if it's an uncomfortable conversation, have a super explicit upfront conversation about how major decisions are going to be made on an ongoing basis. And also, the other thing that I've seen quite a bit is people hire a technical co-founder who isn't really a co-founder and then outgrow them. And in particular, if you've sort of primed somebody to think of themselves as an equal partner in the business, that can lead to a really contentious separation down the road. So again, I'm all in, it's easy for me to say because I'm not the person having the conversation, but from a risk mitigation perspective and not creating problems that are going to play out, after a round or two of raising capital, when you have to sort of make a change, I think it's very important to be upfront with people about what they're signing up for and what their role is going to be, both in the short term, the long term, and ultimately who's going to make the sort of the larger strategic decisions for the company.
So let's get a little tactical about two of those things.
Yep.
If I'm giving away equity as compensation, is there a certain amount of equity even if I don't give the co-founder title, where from a governance or ownership perspective, or from what you've seen as people start to do diligence in an investment round, where you'd say like, hey, like this chunk starts to get in the level that if this person isn't your true partner, like that's just like a lot out of the gate.
Yeah, so it's a very, people often ask like, what's market for a technical co-founder? I have no idea. I wish I could answer that question. It's so fact specific, right? It depends sort of what this person can command in the market. What are the other opportunities they're walking away from? Do you have another option, or is this the only person, who's willing to join the team to help you sort of build product? So there are so many factors that go into what's an appropriate stake. And then there is this issue that you sort of alluded to, which is, let's say you give somebody a 15 or 20%, like a very sizable stake, that can be second guessed after the fact by your investors. And one issue that comes up, this comes up in particular when you have sort of not just one technical co-founder, but you have 3 or 4 co-founder like people, and then you raise a bunch of sort of notes or safes at a relatively low valuation. Investors do care about sort of the founder or founders that they view as the key team having enough skin in the game, or having a large enough equity stake. They'll still be incentivized to sort of build value even after you've done an A, a B, a C, right, and taken 20 to 25% dilution a couple of times. So there is this tension when you're onboarding somebody, even if they're a co-founder, or just they're an early sort of technical employee that has a unique skill set and can command an outsized equity stake. You want to get them on board, but you also don't want to overly dilute yourself, because that will become a diligence issue, or something that investors may get hung up on in a round or two of financing down the road.
Gotcha. So even if I'm clear, and just to clarify, with who's running the company, who's in charge of what, there isn't some threshold of ownership, at least south of 50%, that entitles this person to any kind of power within the company.
Well, so yes and no. This is where we're going to get to the more sort of legal aspects. You're right that if you start handing out 10 and 15% chunks, and suddenly other people own a majority of the voting stock, then unless you do something from a legal perspective, so put a voting agreement in place or do something else to lock in board representation, the default rule, and again, I'm assuming we're just talking about sort of Delaware companies, because that's always what you're going to see with venture-backed startup. It's just a majority rules vote to put folks on the board. So as soon as you lose or are close to losing, an outright majority of the voting shares, it's probably worth putting some sort of agreement in place to document who controls the board. And
so that's a key consideration, actually. I could make myself the board member because I founded the company.
Yeah.
And then I go find this really amazing technical team that I can't afford otherwise. And I give them each 20% of the company. And I'm thinking, well, I own 40, I outrank them, but combined as a team, if they are 60% owners of the company, they can, in most cases, unless it's otherwise, written into the documents, they can start nominating themselves to the board and outvote me or vote me out.
That's right. And if you're an early stage bootstrap startup, you're not going to want to pay somebody like me to draft a 25-page stockholders agreement. So often people don't do that. And again, this is a relatively uncommon scenario where you're giving away a majority of the shares. Like if you're giving away a majority of the shares before you've raised a round of capital and sort of put some sort of stockholders agreement in place, chances are things are not going that well already. But in that scenario, it is worth having somebody prepare a document to make sure that whoever's supposed to be on the board is locked in on the board, and then you'll revisit that when you actually go out and raise capital.
Gotcha. Okay. So let's say we've gotten some good legal advice, and things are going in a nice direction. We've put our prototype together. We haven't given away too much equity to the company. we want to go out and raise. Not a ton, but enough to kind of get us going. So, it's probably going to be some kind of saves or note because it's not a big round yet. Um, and one of the questions that comes up actually from both sides is, so as a founder, I'm pitching and there's a bunch of interest and people say, well, I'd like to invest, but I want all this other stuff. I'm going to give you money, but I'd like to be a board member, or I'd like to be a board observer, or I want information rights. From the investor side, you could see that, like, hey, I'm giving somebody money. I want some insight into what is happening at the company. Let's start from the investor side, actually. If I'm writing a check and, not a particularly big check, but I want to do at least the minimum amount of just oversight to make sure that I have some sense of what's going on at the company. What are the mechanisms I have at my disposal to do that as a non-majority, non-lead check, but something a little more than an angel?
Yeah, so look, there's a broad range of options. What's market or realistic given your check size is probably a narrow range of options. But there are some investors out there, even in a sort of non-lead role where they're cutting a meaningful check, take board seats. That's usually because the founder wants them to be on the board. From a founder's perspective, I usually tell people to avoid giving up board seats unless there's a very good reason to do it, and to not necessarily think about their board in terms of people like buying a board seat, right? They just get a board seat because they're cutting a large enough check. There should be a reason to have folks on the board. On the investor side, I speak with clients a lot, and especially at the early stages, right, where it's sort of, maybe it's a 1 or 2 founder team, they don't really have a product, they're going to take this money, try to build something and raise in 12 to 18 months. Ask people if they really need a board seat, because once you're on the board, there's, you're a fiduciary, there are all these other obligations that you have, looking out for sort of the company, not your own personal interests, and also being actively involved and sort of informed. And often at the early stages, people aren't holding formal board meetings, right? Like it's very common for people to raise, a note or even a small priced round, give away a board seat, and not have a board meeting until after they've done a Series A. So, the range of options is you can get a board seat, but again, at the early stages, I don't know that that's necessarily going to give you a ton of visibility unless it's the type of seed stage company that's having sort of formal board meetings periodically. Or you can ask for whatever sort of information or oversight or governance rights you want via contract. I'd say that's we're talking about a like $1 to $2 million investment in the aggregate. I'd say that's probably a more normal outcome, at least the past couple of years, versus giving away a board seat. And
Gotcha. Because the board, and just to clarify, because some folks are coming to this from the beginning,
yeah.
The board necessarily doesn't have specific definition as to like what actually makes a good board meeting and is it useful, but you can be very specific about what information you want to see.
That's right. Yeah, you can. And look, there's no guarantee that the company's actually, you can write a 15-page, letter that details all the sort of metrics you want to see in the financials and whatnot. There's a separate question of whether or not early stage startup's going to deliver all that stuff. But yeah, you can get a lot more granular about what information you're sort of entitled to get via a side letter or some sort of contract. The issue from a legal perspective, the issue with joining the board is that there's this whole set of responsibilities that come with that. And there are these expectations around how you will behave and be involved in decision-making processes. And, not all startups, especially early stage startups, have the resources to get you the information you need, keep you informed in the way you're supposed to be informed. And it can put you individually in sort of a tricky spot, especially if things don't go well for the company, right? And you have to make a difficult decision about a future round of financing that's going to be highly dilutive. So there are some instances where you don't necessarily want to be on the board. And one approach that I've seen some early stage investors take, where it's like they want to strike the right balance between potentially being on the board if they feel they need to, is they have the right to have a board seat, but they don't fill it, right? So if the company is at a stage where it makes sense to have periodic board meetings and to have that sort of outside oversight over major strategic decisions, they can fill their board seat, but they don't have an individual investor who's in the seat, who's exposing themselves to potential sort of director-related liability issues.
And that's different than being a board observer.
That's correct. Yeah. So a board member is a much more legally significant role. There's a ton of
What
case
is that? Like, what do I, if I become a board member, let's define what that, like, what am I signing up for? What do I actually get, and what am I exposing myself to?
Yeah, so you are signing up for being a member of the sort of group that's the ultimate manager of the company, right? That gets to hire and fire the CEO, that has to approve every time you're issuing equity, that has to approve if you're selling the company. So, there's not like a definitive cheat sheet of what's a board decision and what's a management decision, right? And that changes based on sort of what stage the company is at. But ultimately, the board is the manager of the enterprise as a whole. And the board and each individual director has fiduciary duties to essentially look out for the interests of the company or the sort of stakeholder base as a whole, right? All of the stockholders, and to maximize value. And there's also an affirmative obligation to sort of be informed and be engaged, and not just sort of be hands off and let the CEO run the show. And that's where people, I think, can run into issues, especially with early stage startups, where again, you don't have people internally who can help with pulling together financials or monthly updates. It doesn't necessarily make sense for a 2-person founding team to prepare a 45-page slide deck and spend 3 hours presenting it to the board. Because again, there is an obligation to keep yourself informed and be engaged and sort of keeping up with what's going on with the company and what sort of larger strategic decisions are coming down the pike.
Let me ask you a question. You said that you were a fiduciary for the company, and then you said stakeholders. And there's such a thing as the company, the brand, the mission, all of the other stuff that is not necessarily the shareholders.
Yeah.
I'm thinking in some instances where you might have the only way for a company to survive is in a situation where the shareholders get wiped out or something, but you can still service your customers, you can still employ people, but the actual shareholder base may not be served well. As a member of the board of directors, am I serving all the shareholders? My shareholders, let's say I'm a VC and I have a fund or a syndicate, or is it this other thing, the big C, the company that is this, amorphous thing that is beyond the shareholders?
Yeah, so we'll assume that we're just talking about a normal Delaware C Corp.
Yeah, for sure.
And then the answer to that question, well, there's one easy answer, which is like, you're not looking out for your fund. And that's right. You're looking out for generally the stockholder base as a whole. The one exception is that if the company is insolvent, and there's a bunch of sort of ambiguity about when you're solvent versus insolvent. Once the company is insolvent, fiduciary duties also run to creditors as well. So we can talk about how to deal with sort of it may make sense, especially given what's going on, in the fundraising market and in the economy generally, to talk a little bit about sort of stuff that comes up in the wind down context. But assuming the company's not insolvent, your fiduciary duties run to the stockholder base as a whole. But you should really think about this in terms of maximizing value for the common stockholders. right? So it's the typical structure for investments, at least in the VC space, is you either have a safe or convertible debt that has sort of the right to be repaid before common, or preferred stock, which again has a right to be repaid before common stock. You're trying to maximize value for the common stockholders for the sort of residual claimants.
Because then you're covering everybody above that as well.
That's right.
Gotcha. So that's an interesting consideration, because at least from the LP world, people who invest in funds, a lot of times those people might ask a due diligence question of like, how active are you in these companies? I want to make sure you're looking out for our interests. Like, are you taking board seats? But in some way, that's actually the wrong question, because I mean, yes, you get carried along with the rest of the cap table, but the board member, by definition, is looking out for everybody in the aggregate, not just their own fund interest, theoretically.
Yeah, well, so it's funny because I understand what you're saying. There's this tension, especially for folks that have sort of a VC fund with LPs, where they're sort of this dual fiduciary, right? They're looking out for two separate sets of people that don't always have aligned economic interests. But I think a lot of LPs view, their GPs like taking board seats positively, because it does give you, it puts you in a position to make sure that there's sort of appropriate outside oversight, and also to help push the company to do the right thing from a process perspective. One of the big mistakes that I see startups make is essentially not doing a real market check, not running a real process when they're raising funds, or when they're trying to sell the company to avoid a wind down. And then suddenly, the board finds out that there's a month or two of runway left, and you're scrambling to get a transaction done, and it's messy, and the stockholder base aren't informed of what's going on. So having an outside voice on the board who can essentially force the company, right, both to have sort of periodic check-ins where they're reporting, but also, push them to try to get ahead of problems, I think leads to much better outcomes, and it also in some ways helps mitigate risk for directors as well.
Gotcha. So to that end, in terms of keeping everybody, informed and making sure everybody kind of knows what's going on, some of these startups, and we'll talk a little bit about what it's like to be, one of the smaller investors. Some of these startups have a lot of folks on the cap table, and maybe there's one or two investors on the board, maybe another who has written a big check that is actually just kind of active and checks in with the company, and then you got a lot of little guys, and they don't necessarily all have information rights that they've signed up to, or maybe they asked and they didn't get them. Is there any kind of best practice for how you would counsel founders to check in with that base of folks that doesn't necessarily like legally have a right to information, but you probably don't want to surprise? And what are the considerations with dealing with those folks?
Yeah, so it's difficult, and I would say the practice, like there's a wide range of how companies approach this in practice. I would say the default that ends up happening is people just don't keep smaller investors in the loop, because they're already working 36 hours a day, and the idea of pulling together an investor update just doesn't seem appealing to them. I would not say that's the best practice at all. There are some companies that will do, monthly is a little atypical, but sometimes sort of a quarterly or just a periodic, whenever there's an update, blast email to their investors, including all the smaller investors, to keep them in the loop. I do think that makes sense a lot of the time. One of the reasons that people, I think, stop doing that is there's concern about sort of what information is getting out there in the market, or those updates going to competitors, things like that. So I would say the most common path that I see among companies that are good about keeping their investors in the loop is at the early stages, there's broader communication. Once they get a little bit larger, they tend to sort of tighten the circle of investors they keep in the loop on material business updates, unfortunately. And what the best practice is, you know, on an ongoing basis, you could argue either side. It depends a little bit on what information you're putting out there, right? It could actually not be beneficial to the company if you're emailing 200 people with sort of sensitive updates about, you know, are you getting traction or you're not getting traction, strategic issues, things like that. I would say that as soon as you are, well, I would say that it's good to at least have your stockholder base as a whole feel like there's someone in the loop, even if it's a minimal amount of information, but sort of keeping people updated, even if it's publicly available information that's already been announced. That just generally will lead to a happier stockholder base. And then if you do think that there's going to be any sort of distressed transaction, right, whether it's a down round or a recap, or the company is going to wind down, or there's going to be a sale of the company, you know, or you may explore a sale over the next year or two, I think it makes sense to try to sort of re-engage with the stockholder base as a whole. Because one of the, you know, we can talk about sort of the legal framework for when there's risk or not risk of a fiduciary duty claim, but one of the things that is within your control is whether or not people feel blindsided by a specific transaction, especially when it's bad news. And in a lot of ways, sort of how upset your stockholder base is, whether or not they feel like this is, you know, they're getting looped into a sort of dilutive or not necessarily the type of exit they wanted to at the 11th hour, that will actually determine whether or not you do run into potential liability in a lot of ways. Whether or not
And
there's
is that because you can make the case that, like, if you as a shareholder knew the company was having difficulty for a long time and then like never stepped up to help facilitate any other kind of transaction or never offered any, you know, financial support on yourself, you sort of no longer have as much of a claim because like you had plenty of time to help and you weren't really that helpful.
Yeah, you know, I've always thought about this and the sort of benefits of keeping investors informed. It's in some ways it's less that it really mitigates the legal risk, right? Right. You know, if somebody has a valid fiduciary duty type claim, just saying, well, you were in the loop and you could have offered us alternate financing over the past 2 years, I don't think that's really going to mitigate legal risk. It really is more about minimizing the number of people, right? Making people feel like they're informed, involved in the process, not being blindsided. And, you know, the practical risk for like a director or a founder, it's a function of two things. One is the actual legal risk, right? If somebody is pissed off enough to actually sue you in court, are you going to win? Are you going to lose? You know, are you going to take it to a lawyer and they're going to say you have to settle this immediately, or are they going to say you've got a great case? But it's also a function of, is there somebody out there who's so pissed off that they're willing to hire a lawyer and waste a bunch of money to pursue an actual claim? And that's the second piece.
People management at that, you know.
And it's low hanging fruit and people mess it up all the time, but it has a really big impact on the actual practical risk for somebody who is a director or an officer or another fiduciary. So like that, and then also just if you're joining a board, make sure that they get a real D&O policy and you have some lawyer, make sure you get an indemnification agreement, you have all the sort of right language in the charter documents. Those are the two things that I tell people all the time.
Gotcha.
If you're thinking about practically managing risk.
Right, because you know you have all these folks on your cap table, and you know, surprising somebody is the first step to having them get angry enough to want to go do all the things that you just said. And it's really it reminds me of, like, I had started a company years and years and years ago that ultimately didn't work out, but we used to give monthly pretty detailed updates about our investors, and I'm not sure that's necessarily the way everybody needs to do it. But the day that we let everybody know that we were done, we got some nice pats on the back, some, hey, let me know the next time you do something, because everybody felt like they saw how hard we tried and we turned over every rock. And so it was really, it was eye-opening for me as an investor because I was worried that people were going to get pissed off. And it had been all the communication that was really helped that.
Yeah, and I think it matters a lot when it's not a great outcome, but it also matters when it is a good outcome. And just, you know, even if you're selling for like 300 million bucks, some people on the cap table, for whatever reason, will not be excited. They'll be like, oh, well, couldn't they have gotten another 100 million, right? So making sure that people understand the process that you run, and that whatever the outcome is, it's the best available outcome there was, will make it much easier, both in terms, like, it'll both mitigate legal risk, and it also will mean fewer extremely frustrating phone calls when you're trying to get a deal done, whether or not it's a wind down or a great exit.
Gotcha. So let's talk about the thing that happens in the majority of cases, which is that it's not necessarily a great exit, right? Because the way the stats go on this stuff is that only a small percentage of these companies are going to wind up really returning most of a fund's capital. So in statistically most of these situations, you're either going sideways or winding up, and so you have some really difficult spots. When does my responsibility, I mean, the first thing you talked about is insolvency. Is that the first moment, kind of, and making sure when that is, where I should be worried, or are there other things? I guess layoffs might be, especially now and this period of time, the kind of thing that people are facing the most. But when does the legal responsibility of a company that is not performing well start to kick in?
Well, so when you say the legal responsibility, I mean,
Like uh the the new responsibilities, the, like, hey, this
yeah,
I generally had fiduciary responsibility, but is there some, like, extra stuff that I start to need to do if, for example, I look at this market and I'm like, I think the next round's going to be pretty difficult to raise. We have X amount of dollars left in the bank. We might have to cut some people. I feel like I have extra work to do in terms of my legal responsibility.
yeah. So I mean, I would say it's funny because it's not uncommon in board meetings or talking to people, you know, for people to be under the impression that there's like heightened fiduciary duties in the context of like a down round or a super dilutive financing. And that's not actually the case, right? The same fiduciary duties apply whether or not it's a flat round, an up round, or a down round. And you're right that, for practical reasons, particularly when there's a bunch of uncertainty in the fundraising market, you have limited runway, you think it may end up being sort of a wind down scenario or a really sort of punitive recapitalization type transaction. You want to be super focused on runway, extending runway, cutting costs, right? Whether or not the investments the company, is making in terms of salary or building new product is actually going to like create value for the stockholder base as a whole. But you should be doing that anyways, even outside of it. Yeah, that's just like the most basic, like, staying involved about how the business is doing, understanding the company's cash position, what its liabilities are, how much runway you have, and pushing the company to start sort of fundraising or sale discussions early enough along so you're not scrambling at the 11th minute. Like, you should be doing that no matter what's going on in the economy. Now, people tend to focus on it more when you have to make difficult decisions like, are we going to lay off 30% of our staff, or are we going to have to do some super punitive recap where all the preferred gets wiped out? But that's the type of stuff you should be doing even if it's a two founder startup, they have no employees, you cut $1 million check and you're taking a board seat, like that's part of your obligation as a director. So you should be doing that anyways. From a purely legal perspective, it's the point of insolvency is when actually the group of people you're looking out for changes. Before that, again, the golden rule is you're not looking out for your own personal economic interest. You're not looking out for your fund. You're trying to maximize value for the stockholder base as a whole. And you can think about that in terms of maximizing the return to common stockholders.
And the actual definition of insolvency, because we are essentially, we have a financial plan
Yeah.
to run out of money at some point. So it is a little bit tricky to say, like, when are we actually insolvent? Because we have all these employees that we said we were going to pay, but at some
Yeah.
point we are going to run out of money because
Yeah, so it's a very difficult question to answer, in part because if you look at sort of Delaware case law on this, there are 3 different tests. None of them are super clear, right? There's the balance sheet test, like, do assets exceed liabilities? There's the cash flow test, so does the company have enough cash to satisfy liabilities as they come due? And then there's this other, like, unreasonably small capital test, which, essentially, does the company have so little capital that there's no realistic possibility that it can fund itself? And so making that determination is highly sort of fact specific and difficult to do. One of the good things about Delaware law is, it's okay for directors to rely on outside advisors. So you can get sort of legal and financial advisors involved, assuming the company has the resources to help you make that call. But it's very difficult in practice. I feel like we've been in this, we've had conversations about this, you and I, and it's a very difficult call to make a lot of times, especially when you're in a context where it's like, we've got a potential sale, but there's some risk around it happening, or potential financing, or the alternative is a wind down.
So one of the things that I feel like entrepreneurs don't necessarily take seriously enough, but it is also important, is employment laws in their state, because there are situations where you look at how much you're paying everybody, you look at how many months there are sort of on the cap table, in the balance sheet, and your financials. And it's one thing to come up with an answer that you can do on an Excel sheet of, like, well, if I just paid everybody 10% of what I was normally paying them, well, this company will last forever, right? And all I have to do is sort of go around and ask everybody if that's okay. But there's also a lot of salary requirements, particularly in a place like New York, where there's things you have to know about minimum annual salaries, severance. I mean, even as a founder, I've heard lots of founders say, well, I just won't take salary for a little while. But, like,
Yeah.
technically, you're not really supposed to be doing that.
Yeah, no, it's so this is something.
I don't think the New York State Department of Labor is going to come after you, and if you're a 4-person startup and you're not taking a check for a couple of times. But
well, you'd be surprised. The other thing that people don't realize, I had this happen recently, where I think it was like a 4-person founding team. One of the founders was tasked with deciding whether or not they were going to pay themselves sort of the minimum salary you need to pay. He decided not to. He got sort of fired a couple of years later and turned around and sued the company for a wage claim, even though he was the one that decided not to pay himself. And he can do that. And, like, that's a totally valid claim. So you're right that there are a couple of areas where it's very easy to get in trouble, and also where there's potential personal liability for directors. And the main buckets you deal with are sort of wage claims, taxes, and then also some sort of benefits or risk-related liability. Those can be pretty dangerous for individual directors to navigate. One of the sort of complicating factors about employment-related liabilities is, you're right, it varies from state to state. And sometimes, like, New York City will have its own rules. So you do need to talk, you need to get professional help, as it were. You do need to talk to an employment specialist who understands all of the rules of a specific jurisdiction. And, like, in New York, it's surprisingly easy to get in trouble. If you're paying people below minimum wage, or if you're trying to defer salary, even if you just, like, forget to put workers' comp in place, there are crazy penalties. So it's there are enough, if you're doing, like, a mass layoff, there are enough ways to get in trouble that it would be very difficult to walk through all of them on this call. But that and taxes are 2 areas where I see people get into trouble, and then get very surprised to find out that there's potential personal liability if they're a director as well. So,
Yeah, I've actually seen a situation firsthand where uh, taxes were not being set aside. And so the company was thinking of its balance sheet as, the X amount of cash left on its books, but ultimately some of that cash had been charged to customers as sales tax and was going to come due. And
yeah,
so you can't actually touch that because the state's going to come along and say, well, you actually owe that as a sales tax. And unfortunately, the founder wound up getting stuck with the bill post the dissolution of the company because they wound up being personally liable for it.
yeah, that's the nightmare outcome, right? So that's the whole reason you set up an entity to begin with, is to avoid personal liability. So, um,
So there are some scenarios whereby you have to think about uh, down rounds and accepting possible down round. And one area that I find that's pretty interesting is when you have like a main investor who is also a board member, who is also maybe the only deep pocket around the table, and they're the only person willing to float the company. And I always find it to be an interesting potential conflict, or one where you sort of need board approval to approve a deal, but the deal that is being approved is being offered by the same person who is voting. And it's just like, look, you either take this crushing punitive down round, which is going to wipe out most of the cap table, or the company goes out of business. And I'm part of this vote
yeah,
as a preferred director. Um, am I still like a, a fiduciary to the company at that point? It feels very self-interested from the perspective of the director.
yeah, it's, people, it is a tricky situation to navigate, and there's some things that you can do to try to mitigate the risk. The one thing that's very important is, everybody, I feel like always talks about this in terms of what hat they're wearing, but make it very clear when you're sort of talking about things as a director. And in general, I try to steer people away from voicing any sort of opinion as a stockholder in the context of a board meeting, right? It just creates confusion. But you occasionally will see people who are not super sophisticated about fiduciary duties, who are just in a board, as a director, outright advocating for their own personal or their fund's interests, which is like the worst possible thing you can do. You can do that as a stockholder, unless you're a controlling stockholder. There's some other issues, but you shouldn't be doing it as a director. The stuff, both, even if you're the sort of conflicted director, or if you're just another director on the board and you're faced with sort of a punitive recap, there is stuff that you can do to try to mitigate the risk. And a lot of it is stuff we've talked about before, which is like you push the company, right? They shouldn't just go to an insider and say, hey, will you give us funding? They should have started, the board should be engaged enough to say, all right, the fundraising market has changed. We've got 6 months of runway. It's going to take us at least 4 months to try to secure an alternate offer. So go out, do a real market check. You're in a much better position if you have, a punitive offer from an insider, if you've talked to 60 other VCs versus that was your first and only stop, right? People also typically will do what's called a rights offering, so that even if you are stuck with a lousy deal, you'll go out and give everybody on the cap table who's an accredited investor the ability to participate. And again, a lot of that has to do with making people feel like this wasn't an insider sweetheart deal where it's just an individual VC trying to maximize ownership or taking advantage of the company being in distress. And then again, even though it's not necessarily a purely legal thing, keeping people informed about, we're going through a fundraising process, or we went through a fundraising process and it didn't pan out the way we thought, and this is all the stuff we tried. In doing that in advance, so you're not sticking them with like 100 pages of legal documents and a surprise down round where they're getting diluted by like 45% will help mitigate the risk from a practical perspective, right? It will mean you may get some tough questions from stockholders, but you're less likely to have a bunch of, ticked off stockholders who are questioning the process that you went through to end up with the deal you ended up with.
Gotcha. Cool. So I do want to create the opportunity for folks to ask questions. So if you do have a question along the way, please feel free to use the hand raise feature, and we'll get to you. But obviously being conscious of the environment, I still want to ask some questions about what happens when things work and when there's, good outcomes along the way. And so are there any things along the lines of when you have like multiple offers, or in a company that, is sort of on its way to being sold? What are the types of things that the companies that have the smoothest acquisitions, the easiest rounds to invest, what are the types of things that they're doing from a like legal due diligence standpoint, and how they're like organizing themselves that you see as sort of best practices, or any, kind of pitfalls where you're just like, hey, that was a great exit, but it was tough because the company failed to do X, Y, and Z, and it overcomplicated things.
Yep. Well, look, I tend to get involved on purely the legal side. So the number one issue that I see, just because we tend to be intimately involved with it, is just whether or not the company is sort of buttoned up on the legal and compliance front, has all their ducks in a row. Like, are they on top of sales tax issues? Do they actually have people sign legal documents, right? Do they have records to show to a buyer? That type of stuff. But I think the single, and this is true in the financing and the sale context, the single most important factor is, are you managing your financing or sale process so that it's competitive, right? So you're moving, potential buyers or potential investors sort of through the funnel at the same pace, so you end up with multiple term sheets. Because if you're stuck with just one offer, whether it's for an acquisition or financing, especially if the counterparty knows that they're the only person at the table, you lose so much leverage. And if it's a competitive process, people are more flexible on terms, but they also tend to run sort of a more efficient, quicker process. And the more time you give an investor or an acquirer, the more sort of diligence, whether it's legal or business diligence issues they're going to come up with, the greater the transaction cost, the more painful the process. So if there's like one thing to shoot for, it's just have multiple bidders.
Any resources or things that you recommend if I'm a new investor, don't necessarily have a legal background, to even like get to know my way around what are some of the governance mechanisms on like term sheets, voting rights, stockholders, and stuff like that? Like where can I go to kind of brush up on this stuff?
So I mean, everybody loves the Venture Deals book for a reason. I think it's great. I mean, there's an original sort of term sheet series that those guys did as a blog, but I think it's Brad Feld and Jason Mendelson have a great, I think it strikes the right balance between sort of being accurate on the substance, but also being accessible. And yeah, I mean, I think step one is just understanding the basic sort of fiduciary duty framework if you're gonna be a director, but also just understanding what venture financing documents say, what rights you have and don't have, and sort of what you're signing up to. I mean, a surprising number of relatively sophisticated investors just don't understand the stuff, or are surprised when they realize they can be dragged along into a sale and don't really have to say. So I think step one is just understanding sort of what rights you do and don't have. And then if you're going to join a board, you should definitely educate yourself or have a conversation with somebody who can educate you on sort of best practices as a director, how to stay engaged, what you should and shouldn't be doing, and just understand the basic framework for fiduciary duties.
Sure. Actually, one other question I have too is about employment stuff. Obviously, in startups, there's a lot of churn, and sometimes the case that somebody doesn't ultimately work out, the position essentially outgrows them. Are most of the issues that I deal with from an employment perspective the kind of thing that the larger law firms can help walk me through, or do you see that is there any benefit to like employment specific expertise, especially before I have like a head of people or
Yeah, that, I mean, that was what I was going to say is largely just because of cost sensitivities. People tend to have a sort of head of people or an HR person who handles a lot of it in-house and only calls a larger law firm when there's a major issue. There are sort of employment-focused law firms that are at rates lower than ours that are a good sort of stopgap or can help deal with contentious terminations. I think for a lot of people, if you're having a dedicated HR or employment resource in-house, just having like good forms and a playbook for onboarding and offboarding people is key. And then I think a lot of it has to do with, honestly, not non-legal stuff, which is just like you're hiring and recruiting, sort of the filters you're using, making sure you're getting high quality candidates. And you also are, open and transparent communicating with employees. So they're not blindsided if you do have to make a change and aren't sort of generally pissed off, but leave with a relatively positive feeling about the time they spent at your organization.
So the one thing that I always suggest to companies is it's far too easy when you're, 5, 10, 15 people to do things very seat of the pants in a way that you wouldn't do if you were 30 people or 40 people. But I think a lot of those processes are there for a reason.
Yep.
And to actually use them to, even if you think you're going to rehire the same person you worked at your last 3 startups, to write up that job spec, to actually put that job out in the market, to conduct real interviews, to be really intentional about like who you're interviewing and make sure everybody, earns that position. Because I think what happens is in the success cases, things start moving way faster than you ever anticipate. And you wind up like doubling down on some really bad processes that you wind up having to clean up later.
Yeah. Yeah. Look, it's always a challenge, right? You have a limited amount of capital and time, especially the early stages. So it's always a challenge to get people to invest in this type of stuff, whether it's sort of legal or non-legal. But you're right. I mean, the most effective way of framing it for early stage founders is like, invest the time to do it now because this could go horribly wrong, right? The cost associated with a bad hire, even leaving aside if it's like they threaten to sue and you have to pay them off or something like that, just onboarding somebody and then offboarding them later, like it's such a time suck and so expensive, right? You want to have a process for getting it right in the first place, and you also want to have a playbook. If you do have to offboard somebody, where it's like, the CEO doesn't have to be the person who's handling terminations. You can just hand it off and it's like plug and play. You're mitigating risk and you're also not leaving people with a bad taste in their mouth. So, but it's challenging especially at the early stages.
So I just got DM'd a question from a shy person who I won't call out, but and it has to do with like contracts, terms of service, and all of that sort of stuff, especially in a really early stage company. So many companies like copy and paste from what they see elsewhere.
I was going to say, whatever you do, don't just go take a competitor's privacy policy in terms of service, because you're going to leave their name in there. Like no matter how detailed. No, yeah. Look, people do that. It's a challenge. Is the question just how to efficiently strike the balance between cost and having good forms? Yeah. So I would say,
and actually, the question specifically was like, if I invest in a company and wind up taking an important position, maybe a board seat or whatever, should I be looking at that stuff, or should we be doing a legal review of, because it's not always clear. And actually, this would be a question like, do you actively ask the companies that you are working with to give you all of their contracts and stuff like that? Or is it sort of the hope that they are running it by you? Because I gotta imagine it's pretty hard to, you can't be on top of things you didn't know were being signed.
Yeah, well, it's both for like outside counsel, but also for director, like you typically are not looking at, as a director, you shouldn't be looking at every single piece of paper, right? That's
Right.
sort of ultimately the CEO and the in-house legal team, or there's somebody tasked with that responsibility. So from a director's standpoint, you want to make sure that they have sort of appropriate processes in place, that they have some sort of outside counsel. And again, not looking at every single piece of paper, but there's somebody who can act, like make the judgment, okay, this is like a catering contract, we don't need to send it to outside counsel. This is a like day-to-day commercial contract, we're going to send it to somebody appropriate. And this is the stuff that we send to like our, most expensive outside lawyer.
Right. So we're really like diligencing the process. So if you get into that meeting and say, hey, by the way, our sales contract, has anybody looked at that? Where did we get it? And let's just make sure that, we're on top of it. But not necessarily, at some point you have to trust the founder that if they're making a tweak here and there, that they're doing the right thing.
Yeah, and I would say at the earlier stages, it's relatively unusual to have outside directors who are getting in the weeds on like sales contracts unless there's some huge issue, right? So the board definitely has an oversight function, and they need to make sure that the sort of management team is appropriately managing risk. But in practice, a lot of that is just relying on the judgment of the management team, and then occasionally checking in on specific hot button issues, right? Like cybersecurity and privacy have been areas of focus over the last couple of years, and I think are a very appropriate thing to ask about at the board level. Same with sort of appropriately managing employment-related risk, because that's something that comes up a lot. But at the end of the day, you're more sort of validating that the company has an appropriate process in place, but typically not getting super in the weeds on how the day-to-day function.
Cool. Listen, Alex, thank you so much for giving us a lunchtime hour here. I know you've got your email right there as your screen name there. It's easy. It's easy because it's area at Goodwin Law, and really appreciate the time. I can vouch for working with him and other folks at Goodwin, and just really in general. I just want to double down on the point that spending money on appropriate legal counsel and representation and folks who've been there and done it before. I can't tell you how many times a startup has gone cheap in the beginning, and somebody they know or somebody outside of doing this on a regular basis, where it just winds up costing so much more in the end. It could be half the hourly rate, but 3 times the hours in the end, and it doesn't necessarily pay off. So I'll put a pin on that. Thank you so much. I really appreciate your time.
Yeah, thanks so much for having me.
All right, so long, everyone.